You see those headlines about bank frauds start flashing, and it's hard not to get that sense of déjà vu, right? That feeling of, oh no, are we doing this again? Is another crisis brewing? Well, today, we're getting a direct line of sight from inside the industry. We're going to break down how one top bank CEO is thinking about the risks, the strategy, and what the future of banking really looks like. So, this is the question on everybody's mind. When you hear about alleged fraud popping up at regional banks, it just dredges up all those bad memories of past financial meltdowns. You can't help but wonder, is the whole system a house of cards? But is what we're seeing now really a sequel to the last crisis, or is it something totally different? All right, to really get to the bottom of this, we're going to walk through four key parts. First up, we'll tackle that huge question head on. Is a crisis brewing? Then we'll peek inside one bank's risk playbook. After that, we'll see how that playbook holds up with a real-world test on auto loans. And finally, we'll look at how they're flipping the script from defense to a huge, Texas-sized opportunity for growth. Okay, so let's jump right into the deep end. Are these recent fraud cases we're hearing about just the tip of the iceberg? And look, the concern is totally understandable. When you read about bad actors trying to pull a fast one on banks, it brings up a really basic question. How well do these banks actually know who they're lending money to? And more importantly, if one bank takes a hit, could that problem spread like a virus? Well, that brings us to the perspective of Huntington Bank Shares CEO Steven Steinauer. When he was asked about all this, his answer was incredibly direct. He basically said, it's a one-off. He doesn't see these as signs of a sick industry, but more like isolated incidents. And this is where he draws a really sharp line in the sand. The recent fraud cases, he says, are about making character judgments, deciding if a particular client is trustworthy. But that's a whole different animal from the Silicon Valley Bank collapse. That he calls a liquidity deposit challenge. So in his mind, one is about individual bad actors, and the other was about a flawed financial model. Apples and oranges. And he really doesn't pull any punches. His final take on whether this could spread and infect the whole system? He thinks that fear is grossly overblown. So if he's not worried about that, what exactly is his bank doing to stay on solid ground? So, how does that kind of confidence actually work in the real world? Let's go behind the scenes and look inside their risk playbook to see how they build a real strategy for stability. Their whole strategy seems to come down to three big ideas. First, make sure everyone's interests are aligned. I mean, when your own employees and bosses are one of your top 10 shareholder groups, everybody's got skin in the game. Second, be an open book. They've published their credit metrics every single quarter for the last 15 years. And third, just be consistent. They've stuck to what he calls a moderate to low risk appetite for that entire time. No wild swings, just a steady hand on the wheel. And this brings us to a number that really shows the strategy paying off. 22 basis points. That was their charge-off number in the third quarter. Now, a basis point is just a fancy term for 1/100%. It's a super tiny measurement. And what's amazing is he points out this is actually below what they'd even consider a normal rate. It's a tangible result of that consistent, low-risk approach. And hey, just so we're all on the same page, a charge-off is basically a debt that the bank has decided it's probably never going to collect. It's a loss. So it's pretty simple. The lower this number, the better. And that 22 basis points, that's a sign of really strong performance. Okay, so having a good playbook is one thing, but how does it actually perform under pressure? Let's put it to the test and look at the auto loan market, which, let's be honest, has been hitting some serious bumps in the road lately. And here's a number that just perfectly sets the scene. For the very first time in history, the average price of a new car just passed $50,000. Think about that. That is a massive chunk of change for most people. So you have these sky-high prices, and you're hearing reports that more people are falling behind on their car payments. The obvious question is, are banks like Huntington getting spooked? Are they starting to tighten the screws and make it harder to get a loan? And his answer is a flat no. And this really gets to the heart of their whole philosophy. They aren't tightening their standards now because, as he puts it, their underwriting has always been very, very tight. The strategy isn't to react to every market swing. It's to keep the same high standard no matter what's happening. And because they're so consistent, they have this deep well of confidence. He says that even if unemployment were to shoot up dramatically, they still expect their loan portfolio to do just fine, with maybe only slightly higher losses. It's a belief that's been built over 15 years of doing things the same way. So we've seen the defense, that focus on stability and managing risk. But what about the offense?
Let's move on to the last piece of the puzzle, how they're shifting from just playing defense to actively going after growth.
And their growth plan couldn't be clearer than with this recent move. They just closed a huge deal, buying a bank holding company in Texas called Vertex. This is not a bank that's hiding in a bunker. This is a bank making a major play to expand. I love how the CEO puts it. He doesn't just call it an acquisition. He says Texas is a springboard opportunity. You can just picture it, right? It's a launch pad for whatever's coming next for the bank. So why Texas, of all places? Well, the strategic thinking seems pretty clear. The move is meant to build on what he describes as extraordinary growth they've had for the last few years. It gives them a solid foothold in two massive economic hubs, Houston and Dallas. And he sounds genuinely excited about the market there, especially the enthusiasm he sees from local business owners. The end game? To take their results to a whole new level. And all of this brings us to one final big thought. This entire strategy we've looked at, it's all built on a foundation of consistency, of being an open book, and of not taking crazy risks. It's a 15-year game plan that avoids chasing the latest hot trend. And it leaves us with a really interesting question for the world of finance today. In an industry that's so often about boom and bust, does slow and steady still win the race?